Hello, ladies and gentlemen. This is Osman Ali, and I'm recording the video for a numerical uh, graphical analysis on a call option. So let's take the data as that we want to purchase euro, but I'm gonna do it for both buyer and seller. So we're gonna buy euro, and that's is equal to $1.5. So that's the contract we have signed. We call that contract price, strike price. You can say option rate. The quantity of euros that we wish to buy is $1. So making the life simple, that's $1. Otherwise, whatever the rate is, you can multiply that with the quantity, and you can get the total contract value. Contract we are signing it today. Let's say it's 1st of June 2020. So the contract expires on 30th June 2020, which is the exercise date. Okay, and the option premium that we have is $0.10 on the €1 that we are buying. So you do understand the basic requirement of the option premium, that actually option premium is the extra amount of money that is paid by the option buyer to the option seller. You do understand who is the option buyer, who is the option seller, who is the commodity buyer and commodity seller, or the asset buyer and asset seller. We have already discussed that in the PPT. So assuming you have the basic knowledge, let's go for a graphical analysis, or let's see the profit and loss situation of the buyer and as well as the seller. So my first graph would be actually related to option holder. You can also call this guy as option buyer. So it is a call option, and with respect to option buyer. So just to start, option buyer is that person who pay the premium to the option seller. So if option buyer has paid the premium, it means there is an already cash outflow of $0.10. Okay, and this is like a sunk cost. If the buyer chooses to buy the euro from the seller or not, in both cases this money is not gonna come back to the buyer actually. Okay, so that's the option premium. Now let's start making a graph here. So this is a market line. Let's call this as market line. On the market line, we're gonna jot down all the possible market prices that we may have during this time, and this is the premium line. Now we have paid a premium of $0.10 as an option buyer, so I can write here minus -0.10. You can make any scalings here, like I can make a scaling of minus 0.05 and minus 0.10 directly. Otherwise you can make it like minus 0.1, 0.01, minus 0.02, and likewise till 0.10. And I will make a short scaling of plus 0.05 and plus 0.10 here. So that's my premium. Now option buyer is the person who have paid the premium, so that's a minus. So the buyer graph starts from here, and it will cross the market line, and then it will gonna go above. Now at what particular point it should cross, for that let's go into the detail of market line. Now it's not a standard, but I do it to make things simple. So looking into my looking into this line, I would just choose a mid line, which I feel is the mid. Okay, and this point I will scale it at 1.5, or I will call it as 1.5, which is the contract price. So I always do it like this: put a line and start from the mid, and we say that that's my contract price, 1.5. Then on the right side of it, I increase the price like 1.6. So if you see, I have increased it by purpose. Exactly the difference is the same as my premium 0.10. That's by purpose, just to make things simple. Actually, that's why. You can give any scale which you wish to give. Then 1.7, after that 1.8, then 1.9. So exactly I'm using the same scale. And on the left side, then it will decrease 1.4, 1.3, 1.2. We can have 1.1 also. So that's the market line. Now obviously every currency has an expectation, And the economists, the financial analysts, speculators, they try to estimate the possible range for a currency. That, let's say if I'm talking about euro and I have signed a contract on $1.5 per euro, so it is possible that we may have a range of this euro, that probably there is this 95% chance that the price of the euro would be from this to that, let's say from 1.3 to 1.8. Within this range, it's 95% confidence is there that this will be the price of euro after 1 month. So actually, we do these things in real life. Okay, and how to have that thing or what factors are involved, that's another story. There are multiple factors for that, and they are in our coming chapters actually. So let's do a small comparison of the market and the contract price. Okay, so let me just assume some random market prices. You do know that contract price is something which always remains same, and market price is that price which will change with time. Okay, so contract price is 1.5. Contract price will be 1.5 no matter whatever is in the market price. Actually, contract price remains same. So let's say there is this on the last day, on the exercise day, the contract price is 1.5, but the market says that it is 1.8. Okay, so look at this now. I'm a buyer of a euro. Okay, and if I buy this euro using the contract, then it will cost me less as compared to the market. So it means that it's better for me to go and use the contract. Okay, let's say the contract price is 1.7. So once again, sorry, not the contract price, the market price is 1.7. So once again, if I see, so buying euro from the contract cost me less. It's cheap for me, so I will go for the contract. If the prices are exactly the same as I have contracted, so this is called indifference point. If I buy it from the market or if I buy it from the contract, it remains same. While let's say if the price in the market is 1.3, then I need to pay $1.5 using the contract to purchase 1 euro, whereas I can only pay $1.3 to purchase the same euro. So I would say that market is on a better side for me. Let's put 1.2 as well. So even in 1.2, market is cheaper than the contract. So wherever I have these similes, I'm going to use that thing. Actually, it means that I'm going to go for that place. So look at this. The buyer graph starts from the bottom and it straight goes to the indifference point of 1.5, which is the indifference point. So let me label it indifference point. And then, so okay, look at this. I have already paid as a buyer point $10 per euro as a premium. If I choose to exercise this contract to buy the euro from this contract, then it means that I have to pay more minus $1.5 to purchase this 1 euro. Okay, if there is nothing, so there is 0, I can put a 0 here. Overall, if I solve this, it becomes minus 1.6. It means that this 1 euro actually costs me 1.6, not 1.5, because 0.10 is that premium money, which is the extra money I have paid. It's not an advance payment, okay? So 1.6 is that point which is actually called as a break-even point, a point where there is no profit or there is no loss. So look at this. If the prices in the market is 1.6, so it means that this 1.6 is equal to what I'm actually paying using the contract. I'm also paying 1.6, so it's kind of like no profit, no loss. Okay, so I hope you do understand now the difference between the indifference point and the break-even point. So indifference point does not focuses on the profitability of something. It just simply says that the price in the contract and the price in the market is same, where the break-even point focuses on the profit and loss thing. And then the line passing from 1.6 will continue growing this side. Okay, so now we have these two sides. One is this portion of the graph, and the next one is this portion of the graph. This portion is that portion where if the price of the what you say euro is 1.2 in the market, it is that point where market is good but contract is not good. So you may see a little bit contradiction in this table and this graph, because this graph is shows my decision based on, am I going to use the contract, or I am not going to use the contract actually. Okay, so if I look into this place is actually called as loss region. Why it is called as loss region? Because if the prices in the market is 1.1 or 1.2 or 1.3 or 1.4, in all these situations, if these are the prevailing prices in the market, then market is better for me, contract is not good for me. So just don't get confused because of this 1.2, that sir 1.2 is good, why are you writing here loss? Loss is not because of the market price. Loss is, okay, when the price is 1.2 in the market, then if I use the contract, it will be a loss for me. So a wiser decision would be not to use the contract and go and buy from the market. Okay, you can also call that as not in money or out of money, or option not exercisable. Okay, I will write one of it here, option not exercisable. Now if you come here and see here, you have 1.7, 1.8, 1.9, and then you may have 2.0 and others as well. So this is that region where market prices are expensive than the contract price. So it is that price which is that place where I would say that this is my profit region, or it means option exercisable. It's the place where I will use the contract. I will honor the terms and conditions of the contract. So that's the only part. It's little technical, not very technical, but a bit. So that's the only part you need to just remember it and keep it in your mind, that when you're going to use the contract and when you are not going to use the contract. So obviously you're going to use the contract when the contract price is cheap as a buyer for you. Okay, and if you are using the contract, then obviously you are not using the market. So when the prices in the market are less than the contract one, then you don't use contract. But when the prices in the market are higher than the contract one, then you do use it. So that's the buyer part. Let's go to the seller part also. Okay, option seller. So option seller is that person who have actually received the premium from the option buyer. So if the option seller has received it, it means he has received an option premium. Okay, so let's make a premium line, and then we have this market line. So I will write here, this is premium line, this is the market line, and previously as discussed, I would search for the midpoint and I will use starting point, which is my contract price. Then I will keep a difference of exactly whatever my premium is. So exactly 0.10, 0.10, 0.10. And then I have on the left side, I will decrease it. And let me scale the minus 0.10, the premium line. This would be minus 0.05. This is minus 0.0, sorry, plus 0.05. And let's say this one is plus 0.10. Now option seller is that person who have received the premium. So the option seller graph starts from here and everything remains same. Okay, so you do know this thing, that a profit for the buyer is a loss for the seller, and a loss for the buyer is a profit for the seller. So we go vice versa here. The line would remain same. It starts straight and goes straight to 1.5. Then it will crosses 1.6, which will be the break-even point. So look at this. Why again 1.6 is the break-even point? Because the seller has already received the premium. If the buyer chooses to buy from the seller, then it means the buyer will pay $1.5 more, which in other term, or in other words, we can say that the seller will receive more, or in total the seller will receive $1.6 per that €1 he is planning to sell. So that's why 1.6 would be the break-even point, and then the line will pass on. Now, as this region was actually a loss region for the buyer, then we apply this vice versa rule here. So this region will be the profit region for the seller, or you can say option exercisable. And if this is the profitable region for the buyer, then this is the loss region for the seller. So that's the payoff profile for the call option. So call option was the right to buy, where we were trying to buy a euro, €1, okay, and that's the overall situation. So we, before finalizing our decision, we try to compare the prevailing market prices with the contract prices, and then we see which one is a better trade-off for us from where we can buy. Because as you know, in options contract, you have this liberty of deciding that from where you will buy. Are you going to continue with the contract, or no, you will leave the contract and you will move to the market and buy it from the market. So you're going to decide if whichever place is a better off for you. Okay, and we also discussed this thing that if the prices in the market like 1.1, 1.2, 1.3, 1.45, if they are lower than the contract price, then utilizing the contract or exercising the contract may not be a good decision, because that is a loss region for us. And if the prices in the market are higher than the contract one, so then it will be a profitable decision to make. Okay, and the seller is actually the vice versa of the buyer. So that's the overall concept of the call option. I hope you got the concept. Thank you very much, ladies and gentlemen. Stay safe.